Stop everything you're doing right now. Tell your dog the walk can wait. If you're in the shower, get out, grab a towel. I don't care. Close the dating app you're scrolling through. She was never going to match anyway. This matters more than whatever you think has your attention at this moment. Are we clear? Good. One more thing before we go any further. If you own silver, physical bars, coins, ETFs, futures, any form of exposure, do not open your brokerage account until you finish this video. If you look now, you'll either panic or celebrate, and either reaction will be a mistake until you understand what is actually unfolding. Welcome back to Paul Barron Academy. Today is January 14th, 2026, and I'm about to explain something that would have sounded completely absurd just 24 hours ago. Yesterday, Tuesday, January 13th, we discussed how the CME abruptly raised silver margin requirements by 15%. They shifted margins from a fixed dollar amount to 9% of notional value. This wasn't routine risk management. It was a desperate attempt to crush the rally, force retail liquidation, and shield the banks buried in short positions. I told you it wouldn't work. I told you the fundamentals were too strong. I told you the physical shortage was real. I told you Shanghai was still trading at a massive premium. I told you not to panic, not to sell. And guess what? It failed. The margin hike failed. The suppression failed. The manipulation failed. In fact, it backfired spectacularly because today the silver market did something I have never seen in my lifetime, something that violates every rule of modern finance, something that mathematically proves the paper silver market is finished. The Shanghai Futures Exchange closed at 104.55 per ounce. At the same time, COMEX spot silver in New York is stuck around 91.67. That is a $13 gap on the same metal, the same element, the same commodity. In a functioning market, this is impossible. In a functioning market, arbitrage traders would buy silver in New York at $91, ship it to Shanghai, sell it for $104, and lock in $13 per ounce in risk-free profit. They would repeat this until the spread collapsed. That is how markets are supposed to work. But the spread isn't closing, it's widening. Yesterday it was $8, today it's $13. Tomorrow it could be $15 or $20. Why? Because arbitrage is not just difficult anymore, it's dead. There is no metal to move. Western vaults are empty. The silver backing futures, ETFs, and paper claims simply does not exist. It's already been drained by smart money that saw this coming months ago, and now the system is cracking in real time. Let's talk numbers because numbers don't lie. Politicians lie, banks lie, media lies, math does not. Yesterday, Shanghai closed at 93.31 while COMEX sat near $85, a historic anomaly. Today, Shanghai exploded to 104.55, an 11% plus move in a single day. That kind of move doesn't happen in a stable commodity. That happens in currency crises. That happens when control is lost. That happens right before systems fail. COMEX did rise from $85 to $91, but it didn't even come close to keeping pace. The premium is now nearly 14%. When a fungible commodity trades with that kind of premium, only two explanations exist: a logistics breakdown, a supply collapse. Planes are flying, ships are sailing, infrastructure is fine. So, what's left? There is no silver. Dealers are empty. Mints are backlogged 8 weeks. Vaults can't source deliverable metal. And even if someone did find silver, new export licensing rules mean once metal enters China, it cannot leave. The bridge between East and West has been blown up. This is the end of the unified global silver market. We now have two realities. Paper silver, West, $91, futures, ETFs, contracts, physical silver, East, 104 plus, real metal, real demand. Which price is real? The physical one. The $13 spread is the proof, the smoking gun, the mathematical evidence that paper silver has lost all credibility. To put this in perspective, gold spreads between London and New York are measured in cents. Copper spreads might be $1 or $2, but $13 on silver? That is a market failure. 2 weeks ago, the spread was $5, last week $7, Monday $8, today $13. The trend is accelerating, and the root problem, the physical shortage, is getting worse, not better. Now consider what makes this even more explosive. Yesterday's margin hike was designed to kill the rally. For a few hours, it looked like it might work. Weak hands were shaken out, then physical demand overwhelmed paper selling. Price didn't just recover, it launched, and now the banks are cornered. For years, major banks have carried massive short silver positions. This isn't speculation, it's documented. They've been fined hundreds of millions for spoofing and manipulation, but they kept doing it because it worked, until now. Silver isn't $20 anymore. It's not $30. It's not $50. It's $91 in New York, $104 in Shanghai, $132 in India, and climbing. When you short a stock, your upside is capped. When you short a commodity in physical shortage, your downside is infinite. And there is no metal available to cover. This is how shorts become bankrupt, which is why the risk ahead is extreme. Desperate institutions do desperate things, and silver isn't the only warning sign. Gold just hit $4,644, up over 40% since early 2025. Bond yields are spiking, treasuries are being dumped, the dollar is being abandoned. This is a global vote of no confidence. India, the world's largest physical silver consumer, is in outright panic mode. Local prices have exceeded 290,000 rupees per kilogram, about $130 per ounce. That's a 45% premium over COMEX. Markets are sold out. Dealers have no inventory. People are exchanging jewelry and savings for silver because they understand what fiat collapse looks like. The East is awake. The West is still watching CNBC. So what does this mean for you? If you own physical silver, do not sell. Not even consider it. The screen price is fiction. The real price is what desperate buyers are paying. If you own ETFs, understand the risk. Cash settlement at $91 while physical trades at $132 is a real possibility. If you hold futures, ask yourself if you trust COMEX delivery or if you'll receive a force majeure check instead. If you own nothing, the question isn't should you buy, it's can you still buy? Because the window is closing. This is not financial advice. This is reality. The arbitrage is dead. The paper market is dying. The physical market has taken control. The $13 spread is not noise. It's a warning siren. This is Paul Barron Academy, January 14th, 2026. The system is failing. The banks are trapped. The repricing has begun. Decide which side you're on now.